welcome back to Intelligent Investment Today, the podcast dedicated to all things value investment. In this episode, we continue our exploration of classical financial analysis through the lens of Benjamin Graham. In the previous episode, we focused on the balance sheet, the financial foundation of the business. But today, we turn our attention to another critical financial statement, the profit and loss account, or as it's more commonly called in the United States, the income statement. Now, if a balance sheet tells us about a company's financial position at a single moment in time, the income statement tells us something very different. It tells us how the business actually performed over a period of time. Did it make money? How efficiently did it operate? Were profits stable, improving, or deteriorating? And for Graham, these questions mattered enormously. Because while assets provide protection, earnings power is ultimately what gives a business long-term value. Today, we're going to explore how Graham-style investors analyse the profit and loss account, what they look for inside it, and why understanding the quality and consistency of earnings is often far more important than simply focusing on the headline profit numbers. So, without further ado, let's get right down to it. As ever, sit back, tune in, and get ready to take on board another lesson in value investing, as inspired by Benjamin Graham. As ever with these things, it's always good to start with the very basics. The profit and loss account, or income statement, shows a company's revenues, expenses, and profits over a specific period. This is usually reported quarterly or yearly, or indeed both. In simple terms, it answers the question, did the business generate more money than it spent? Now on the surface, this may seem straightforward. Revenue comes in, expenses go out, what remains is profit. But as Graham understood very well, the reality can be far more complicated, because not all profits are created equally. Some earnings are highly stable and predictable, others are temporary, cyclical, or even misleading. And this is why intelligent investors must look beneath the surface. One of the first things Graham focused on was consistency. He strongly preferred businesses with stable, dependable earning records over long periods of time. Why? Because consistency reduces uncertainty. A company that generates reliable profits year after year is generally easier to value than one whose earnings swing wildly between boom and bust. Now, this does not mean Graham avoided all cyclical businesses, but he did recognise that volatile earnings makes valuation far more difficult. If profits fluctuate dramatically, investors may accidentally overestimate sustainable earning power during good times, or indeed underestimate it during recessions. This is why Graham often examined average earnings over many years, rather than focusing heavily on a single period. He wanted to understand the underlying earning capacity of the business across a full economic cycle. And this remains one of the most important lessons in financial analysis today. 1 year rarely tells the full story. Now, naturally, revenue is the starting point of the income statement. Revenue represents the money generated from selling products or services. And while revenue growth can certainly be positive, Graham was careful not to become overly impressed by growth alone. Because revenue without profitability means very little. A company can grow sales aggressively while still destroying shareholder value if costs rise faster than revenues. So Graham focused not only on growth, but on the relationship between revenue and profit. Was the company converting sales into sustainable earnings, or merely expanding for the sake of expansion? And this distinction is incredibly important because markets often become excited about growth stories. But intelligent investing requires asking whether that growth is actually producing economic value. This brings us to margins. Margins are one of the clearest indicators of business quality and operating efficiency. Gross margin shows how much money remains after the direct costs of producing goods or providing services. Operating margin examines profitability after operating expenses. And net margin reflects what ultimately remains for shareholders after all costs, taxes and interest. Graham was highly attracted to businesses with stable profitability. A company with consistently strong margins often indicates competitive strength, pricing power, operational discipline, or efficient management. But again, consistency matters. Temporary spikes in profitability may not be sustainable. This is particularly true in cyclical industries. This is why investors must examine trends over time rather than looking at just isolated figures. Another major preoccupation for Graham was earnings quality. And this is an area where many inexperienced investors can run into trouble, because accounting earnings are not always the same as economic reality. A company may report strong profits, while underlying cash generation remains weak. Or management may use perfectly legal accounting tricks to flatter earnings temporarily. For this reason, Graham thought that investors should approach reported numbers critically rather than blindly accepting them at face value. And this scepticism remains incredibly valuable to this day. Investors should always ask, are these earnings reoccurring? Are they supported by cash flow? Or are they dependent on unusual items, aggressive assumptions, or temporary conditions? Because ultimately, sustainable earnings matter far more than cosmetic accounting results. One area Graham paid particular attention to was interest expense. And this one connects directly back to the balance sheet. A heavily indebted company may generate respectable operating profits, but if large amounts of those profits are consumed by interest payments, shareholder value can quickly become vulnerable. This is why Graham often examined interest coverage ratios. Essentially, how easily can the business meet its debt obligations using operating earnings? Strong interest coverage suggests resilience. Weak coverage may indicate fragility. And during downturns, that fragility can become dangerous very quickly. Again, this reflects Graham's broader philosophy. Financial strength and downside protection always mattered deeply to him. One of the most important ideas in Graham's style income statement analysis is the distinction between temporary earnings and earning power. This is subtle but critical. Markets often become fixated on short-term earnings announcements. Did the latest quarter's profits beat expectations? Did margins improve? Did guidance increase? But Graham cared more about long-term earning power. The durable ability of the business to generate profits over many years. And this is a very different mindset. It encourages investors to think like owners rather than traders, to focus less on quarterly fluctuations and more on the enduring economics of the business itself. But short-term earnings can be noisy, But long-term earning power is what ultimately determines intrinsic value. Another important consideration is cyclicality. Some businesses, by their very nature, experience fluctuating profits due to economic conditions. Commodity producers, construction companies, shipping firms, the airline industry. During boom periods, profits may appear extremely strong, but those profits may not be sustainable. And this creates danger, because investors sometimes mistakenly capitalise peak earnings as though they were permanent. Graham was highly aware of this risk, which is why he often preferred businesses with more stable demand and predictable earnings characteristics. Again, consistency reduced uncertainty, and reduced uncertainty increases confidence in valuation. Graham also understood that management incentives can influence reported earnings. Executives may feel pressure to meet market expectations, maintain share prices, or present results in the best possible light. This can lead to accounting distortions, aggressive assumptions, or short-term decision-making. And while accounting standards have evolved significantly since Graham's era, the underlying incentives remain very much alive today, which is why intelligent investors should never analyse the income statement purely mechanically. Numbers must be interpreted with context. Investors should ask, is this profitability genuinely sustainable? Or is it management managing appearances? Because ultimately, valuation depends on real earning power, not temporary accounting presentation. Now, from a Graham-style perspective, one of the most attractive characteristics a company can possess is durable profitability combined with financial conservatism. Strong margins, stable earnings, manageable debt, and long-term resilience. These qualities reduce uncertainty and improve the probability that intrinsic value will continue compounding over time. This is one reason why Graham's philosophy still influences modern investors so heavily. Because although industries evolve, the principles of sound financial analysis remain remarkably consistent. Businesses that consistently generate healthy profits while maintaining strong financial discipline tend to survive and prosper over long periods. There is also a behavioural lesson embedded in all of this. For income statement analysis encourages patience and objectivity. It forces investors to move beyond headlines and narratives, to examine the actual economics of the business. And during speculative periods, this discipline becomes especially important, because markets often become captivated by stories, future disruption, rapid growth, excitement. But eventually, reality reasserts itself, and reality is reflected in financial performance. Can the company generate sustainable profits? Can it convert revenue into real earnings? Can it survive difficult conditions? These questions ultimately matter far more than excitement alone. And as we bring this discussion to a head, it's worth reflecting on how Graham approached financial statements as a whole. He did not view the balance sheet and income statement separately. He viewed them together. The balance sheet revealed financial strength. The income statement revealed earning power. And intelligent investing required understanding both. A strong balance sheet without profitability may produce weak returns. Strong profits without financial stability may produce fragility. But businesses possessing both financial resilience and durable earning power often form the foundation of long-term value. And this was central to Graham's philosophy. Investing should not be grounded in speculation, but in careful financial analysis. That brings us to the end of today's episode. A look at the profit and loss account or income statement through the eyes of Benjamin Graham. And a reminder that beneath every stock ticker lies a real business with real economics. If you've enjoyed the episode, do add to playlist or subscribe to this channel. That way you'll be alerted whenever a new edition lands on your platform. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.